This is market update 2022. These are current numbers, by the way. As of August the 2nd, I think the number was like 38 and 70. Now sitting at 38 and 74. And that means 38% of our basket of stocks are above their 200-day, 74% of our basket of stocks are above their 50-day. Just very quickly, we procure a basket of stocks every year, July of the year. We only invest in mega cap, means the largest companies based in the U.S. and Canada. We do that primarily for reporting reasons, also to just making sure that all of the financials are in accordance with each other, because international standards can be a little different sometimes in how they account for things. And then as far as the mega caps, those are typically safer, more stable companies, which is why we go for those. We also only invest in companies with a stock price of less than $150. And the reason for that is because we want to try to create a position of at least 100 shares. And so we want to be able to do that across all 11 sectors of the economy. And as we accrue more cash, then we change that number from 150. Maybe next year we'll look at 160 or 170. We started at, I think, 100, and then it moved to like 120, and now we're at 150. So looking to improve that over the years, but right now it's capped at $150. Also, too, we only invest in companies that are paying a dividend of at least 2%. And that also changes depending on what the relative dividend payment is for the market. Some sectors have more stocks than others because of that reason. If we ever get to a point to where maybe one sector does not have any companies that fit our criteria, then we'll look at either doing some corporate bonds for that sector or possibly lowering our dividend standard. But right now, 2% is the minimum. Hopefully, that increases maybe within a year or two. We'll be looking at a minimum of 2.5 or 3%. But we'll see. It's been 2% for the last 7 years. Also, companies cannot have any break in dividend payments. They can decrease the dividend payment, but they can't stop any dividend payment. So if any company, decides this quarter we're not going to pay a dividend, they automatically come out of our basket of stocks. We can no longer invest in that company. And again, every year we reevaluate all the companies in the market, and we create a basket of stocks of companies that fit those criteria. And those are the companies that we follow and we invest in for the year. So very quickly, just want to say, again, 38% above their 200-day, 74% above their 50-day is not good numbers. I know why that is. It's not good numbers, right? So we are definitely in a downtrend, and I wanted to quickly show what that looks like if I can find it. There we go. All right, so oh my goodness. This is the problem with doing things live. You have to end up moving and changing things as you go. But personally, I appreciate seeing how the sausage is made. And so just clicking off all of the 200-day numbers to get a accurate graph here. All right, so this is what the 50-day looks like. This is as of from October through August, so almost a year. And as you can see, it is flat. Clearly there's been a run up over the last month or so, but for the most part, just looking at this graph head on like this, it's flat. It hasn't gone anywhere. And so I think that says a lot about the volatility in the market, which is there's going to be a lot of ups and a lot of downs, but at the end of the day, it hasn't really gone anywhere at all. Let's take a look at the 200-day, and we'll really see this downtrend here. And again, I have to click off all of the 50 days. I don't know a better way of getting this chart to stick. I think it happens anytime I hide and unhide the data on the sheet. And so maybe what I'll do is just stop hiding it. I don't have this problem. So as you can see, the 200-day is definitely for sure in a downtrend. No question about it. We do see a jump from here, but that jump comes off a low, right? A low of July, which was what, 27%? 27% of all the companies were above their 200-day. That's the lowest it's been in the past year. And so this bounce that we're seeing, I don't think is going to continue. And I think we're gonna continue down. With that being said, let's take a quick look at the sectors and kind of see what's going on. So basic materials, 25% of these guys above their 200-day, 58% above their 50. As you can see, they're doing worse than the rest of the market, 34% worse and 20% worse. And so what this tells me is that there's not a lot of demand or faith in the future in building and construction and things of that nature, because we're seeing, like I said, such a poor performance from this sector. Telecommunications, this one was very surprising for me to see. None of the companies in the telecommunications sector are above their 200-day. I mean, that's very, very telling, because telecommunications is basically a utility, right? But there is some of this consumer demand supply thing thrown in because of the fact that you're talking about cell phones, you're talking about TV advertising, and a lot of that is tied to consumer activity. So the fact that the consumer sector is doing so poorly tells me that we're really seeing the consumer being dragged down quite a bit. Let's take a look. Consumer cyclicals. These guys have not performed well over the last probably 4 or 5 months. 17% above their 200-day, but 67 above their 50. This to me looks like a jump or a bump or a bounce, right? Does this continue? Maybe. I think there's still some uneasiness in the market about kind of where we're going. But obviously the consumer cyclical sector is not performing well at all. Although in the short term, again, we may see some real ups and downs there. But long term, though, 200-day, that's relatively a year, only 17% above that's horrible. Consumer defensive sector. These are the companies that we expect to do well, no matter what's going on in the economy. These are the companies that people are going to spend money on no matter what. Like, things have to get really, really bad before we see cans of soup and the like take a big hit. So 50% above their 200-day, 77% above their 50-day. This is definitely a sector that we want to be in. And currently, let's take a look here because I'm curious. Yeah. Coca-Cola is where the program wants us to go, and where we do have an option to purchase shares. So excited about that. All right, the energy sector. This has been hot over the last couple months. 79% of these guys above their 200-day, 79 above their 50-day. Seems like a weird quirk of the numbers, but it is in fact correct. It is interesting though, because 79% is 107% above the rest of the sectors. But then you look at the 50-day, that 79% is only 7% above. So obviously the sector has cooled off some, and I think that's going to continue. But energy, I think, is going to remain a really decent sector to be in until we see something really drastic happen with demand. The financial sector. Again, this one is surprising. None of the companies are above their 200-day. However, 65% are above their 50-day. Typically, in a rising rate environment, the financials and the banks and the insurance companies do really well. Obviously, that is not the case. Now, I haven't gone over all of the earnings reports, but definitely the earnings reports for Regions Financial look really good. And so I cannot imagine why the financial sector has suffered as much as it has. I mean, clearly, if there's recession fears, demand and bank activity and stuff like that will definitely subside. Mortgage home sales cooling off a bit. But I mean, none of the companies above their 200-day seems like either a really outsized down move, or maybe what's happening is the financials were doing so well last year that now relative to last year, even though they're still doing a decent performance, it's not good at all. We'll take a look at some of the individual companies and kind of see what's going on there. All right, health sector has been, I guess at this point, I can say the health sector has done well over the last 7 years. It hasn't really been good. It hasn't really been bad. It's just been there. 43% of these guys above their 200-day, only 29% above their 50-day, means that they've definitely cooled off quite a bit. And I think that has everything to do with the COVID issues subsiding. There's not as many, vaccines and whatnot. But again, decent sector. I don't think it's going anywhere. And I don't see anything really impacting their bottom line, just because even if a lot of elective surgeries and things like that don't happen, they still have the government subsidies and government payments and Medicare and whatnot still lining their pockets for quite a long time. Also, too, inside this health sector are also companies like Walgreens and CVS. So, I can't see it getting so bad that people can't afford their prescriptions. Maybe some of the higher priced ones that aren't covered by the government, but I don't see anything like that happening unless, like I said, things get much worse. All right, industrials. This one I like to see because this to me is very telling. 40% above their 200-day, 80% above their 50-day. Looking at the relative performance to the rest of the market, though, you see this is in line with the market, right? Meaning it isn't really outperforming the market, but it's not underperforming the market either. And this is really good because these are companies, right, that are purchasing these items in order to function and move. And so while the consumer is faltering, that's retail. That's not really a big deal. Like the fact that people are buying less TVs and less new cell phones doesn't really matter much. It really doesn't. The main thing is that our industry is still moving, right? And that's what really drives the economy. That's what keeps everything good. If people are taking less trips, that may hurt some on the fringes of the economy, but the basis of what our economy is wrapped into this industrial sector, and it's doing just fine. All right, real estate. This has been in the news quite a bit. 15% above their 200-day is horrible. 95% above their 50-day. Again, I think this plays right into the fact that, again, there has been some fear. Some of that is subsiding. So that's the reason why we're going to see a lot of volatility up and down. 95% above their 50-day means to me that this move, I think, is not going to be here long, right? Clearly, we may see this continue for another month or so. But when you're talking about 15% above their 200-day, I can't imagine this sector doing any better than that in the long term. So this 95% is obviously a huge move over the last month or so, but I don't think it's going to continue. All right, technology. Again, sort of in line with the rest of the market, and this has been languishing for quite some time now, which again speaks to the consumer. But a lot of this technology is part of, that industrial thing too, because some of these companies are selling directly to businesses and not necessarily to consumers. So the fact that it's slightly underperforming talks tells me that again we have a faltering consumer, but the economy is in decent shape. And again, going back to these companies are made up of the largest dividend paying companies in the US, right? So Hewlett Packard, Corning, IBM, Cisco, Qualcomm, ADI, Texas Instruments, Oracle, Intel. Not a lot of these guys here. And that has everything to do with the fact that dividends are not being paid out consistently, and they don't have very high dividends. Typically, when a company is paying relatively high dividend relative to the rest of the market, it means that this is a cash cow. It means that they're so confident in their ability to generate cash that they can very easily pay out profits to shareholders in the form of dividends without question, without worry. And remember, these companies have been doing this for 10 years without ceasing. Okay, that is a lot. So when you talk about stability, when you talk about reliability, when you talk about risk management and cash protection, this is it. This is what it looks like, right? There's not a lot of these guys in this group, but these guys, like I said, are doing fairly well. They're slightly underperforming the market, but have definitely come back quite a bit. All right, utility sector, last but not least, this is the prime sector right now, obviously, and they have been doing well for the last 3 months at least. Energy was better, but now utility has caught up and surpassed energy. And again, I expect that the utility sector is going to continue to perform well and continue to outperform the rest of the market because the utility sector is typically a defensive play. I've talked about this before. These companies generally get their money and their profits from the government. The government regulates these companies and tells them how much they can charge, when they can charge it. They go to the government and ask permission for raising prices before they can raise prices. A lot of their debt that they issue to the markets is some of the safest debt that you're ever going to purchase. And so everyone is clamoring for utility company debt. So not only are they flush with cash, they have an American populace that's going to definitely pay their light bill, their heating bill, before they do anything else. And so a lot of bad things have to happen before we ever see anything really horrible happen in the utility sector outside of some terrible, natural disaster, right? So again, I expect these companies to continue to work. Let's take a quick look at some of the individual companies. Utilities. Oh, again, this is, I'm not sure why we're having this issue. Let's see. I tell you, it's always something. Look at this. When dealing with software. All right. So, NEM in the basic material sector is the leading MVP, but not performing very well at all. Looks like CTRA is the leading performer in this particular sector. Southern Copper is where we are. Looks like it's second to NEM as far as MVP goes. Just a quick reminder, MVP, every month the program pulls out the best performing portfolio and it lists those companies within the portfolio to just try to figure out which portfolios are performing the best on a month-to-month basis, right? And so whenever this company shows up in one of those portfolios, it's here. So 5 out of the last 12 months, NEM was part of one of the best performing portfolios. Here. So Southern Copper is where we are, 2% or negative 2%. is not great, but again, relative to, the rest of the sector, it's kind of sort of in line. CTRA is obviously an outlier. All right, telecommunications, BCE, British Communications, is the sector leading MVP. I've talked a lot about Canadian telecoms. That's a large reason why we are in Rogers, because it is a Canadian telecom. They don't have to deal with all the competition pressures that the American companies have to deal with. But, looking at the average performance, and this is average per month, right? Average per month over the last 12 months is barely positive, barely positive. And that goes for all these companies in the telecommunications. So just not great performance over the last 12 months. But again, the British telecoms are consistently the better performers. See AT&T down here, huge dividend on AT&T, but negative 3% per month on average is just throwing money away. All right, consumer cyclical. We know that this sector has had some trouble in the past. We've definitely jumped around and hopped around from company to company in this sector more than any other sector of the economy for the last, I don't know, at least 3 or 4 years, trying to find, just one that works for us. International Paper is where we were before. It's the sector leading MVP, but the performance is just horrible, one of the worst in the sector. The rest of these guys are all kind of split, meaning that it's probably not anything to say about any one of these companies because they're all kind of in there. I'm trying to find, GPC is the sector leading performer and where we currently have an option to purchase shares. So really looking forward to starting that position. And GPC is a company that I've looked at for a very long time, and it has for many, many years been said to be a really great company to hold in cases of recession, because these are used auto parts. And so when you have new car sales dwindling, people will continue to use their old cars, and those old cars are going to need replacement parts. And GPC is in a perfect position to take advantage of that. And the fact that they're in a consumer cyclical sector, but it's really a defensive company, is definitely a company I want to be a part of, and hopefully becomes a long-term holding for us. All right, consumer defensive, looks like NWL is the sector leading MVP for whatever reason. Coca-Cola is where we have options to purchase shares, second to NWL as far as MVP goes. 1% a month is not bad at all. And this number, of course, is going to go up and down, right? But at the end of the day, when you're talking about 1% a month, you're talking about 12% in a year, right? ADM is the sector leading performer at 3%, which is a huge number. And the rest of these guys, let's see. Yeah, but everyone in the consumer defensive sector is positive, which is awesome, except for, it looks like, Walmart, Walgreens, Clorox, and Target, which is really interesting. We were in Target a while back. Great company. I enjoyed covering it. I don't know what happened. The price ran all the way up to 200 and change. And being that we were in this company means that the price had to be less than $150. And so the fact that the stock price ran all the way up to 2 something, and now it's back to, I think, like 158 or 160, something like that. So we cannot invest in this company. But it appears that maybe what happened was the stock price just ran up way too high, and now it's come back to earth, basically, right? So I think it's still a decent investment, but just looking at the numbers, it looks horrible. All right, energy sector. We know that this entire sector has just been like crazy. If you look at these numbers over here, 5%, 8% a month is just bananas. OKE is a sector leading MVP. We currently have options to purchase ENB. So not great performance relative to the rest of the sector. We were just in Valero and we're out of that now at almost 5%, Devon 8%, MPC 5%. MPC, interestingly, we can no longer invest in because I think the dividend has gotten too low because the price has gone too high. And, typically, as a company does well, the stock price increases. But if the dividend stays the same, then the dividend yield means the percentage of the dividend of the stock price gets smaller and smaller as the stock price increases. And so typically what's supposed to happen is if a company is performing better, meaning they're making more money and they're more confident about their future earnings, typically they will raise the dividend to stay at some industry or industry level, right? So if the rest of the industry is paying like a 3 or 4% dividend, a lot of times they'll raise their dividend payout to stay at that 3 or 4% or whatever it is, to stay in line with the rest of their competition. Sometimes what happens is the stock price goes so high that the company says, well, we're happy that you guys are excited about the company. We're happy that you guys are buying the stock, but we aren't doing that great enough for us to raise the dividend. And so because our dividend now is so low, that does stop some industry persons like myself who are specifically looking for that larger dividend and won't purchase the stock, which then over time you think will drop the stock price down back to a level in which dividend seekers will buy back into the stock. So just an interesting story because MPC has been around for a very long time and has been a great dividend leader in the sector. And like I said, 5% a month is really good return. All right, financial services. I'm going to say that the MVP is really spread out amongst all these guys, meaning that any one of these guys that you pick to put in your portfolio is probably going to perform about the same. Maybe you can make a case for CM versus CG or something like that. But for the most part, I think just because, first of all, this sector is really just falling off a cliff performance wise, but I just don't think it's going to make much of a difference. The other thing I think is important to note is again, looking at the performance, you see all these guys are negative. They do have some positives here, but they are barely positive. And then the rest of these guys are negative, but barely negative, if not way negative. When you look at JP Morgan, worst performer out of the group at negative 2% a month. We are currently in Regions Financial, which is our largest holding. And the reason why is because Regions Financial was a company that we got into last year when we were looking for companies that had a larger alpha, okay, a better performance, a better stock performance. Now we're looking at less volatility, more defensive type companies. But Regions Financial has that really great alpha. And I think right now, that's what's starting to really, really starting to perform are those companies with those outsized alphas. Alphas meaning companies that perform better when the market is performing well. And I think that with so much volatility right now, that maybe over time, if we continue to see this dramatic and drastic drop, that can change. But for right now, it looks like the alphas is where it's at. So Regions Financial, sector leading performer in the sector, is really good to see. All right. Healthcare. Again, very small sector for us, similar to the technology sector. Pfizer, leading MVP, leading sector performer. Merck is right there with them though as far as performance goes. And I will say that Pfizer's probably the better company, definitely the COVID winner for sure. But as of right now, it's such a small holding for us. We were previously in Pfizer. Pfizer was a legacy holding for us, one of the first companies that we invested in back in 2015, and I was so happy to finally get out of Pfizer and get into something else. But there really hasn't been much excitement in the health sector. But I do enjoy following Merck very much. They have a lot of interesting drugs in their cancer pipeline. All right, industrials. Talked about this a moment ago. Sector doing really well, not outperforming, but definitely in line with the rest of the market. IRM, SWK, sector leading MVPs, really kind of spread out among all these guys. And again, I think this speaks to just the volatility, right? Like we're not seeing just one particular portfolio just really outperform everyone else. It really seems that it's kind of all over the place. And we'll take a look at that here in a moment. The leading performer is CHRW. But yeah, definitely leading performer. The rest of these guys aren't doing so well. RM, I guess, is kind of second in line there. Raytheon is always a decent company. Paychex is where we are, has done really well for us. Happy with the position, and as you can see, they're right in line with the sector leading performance. All right, real estate. We know this has been a sector that has not performed very well as of late. MPW is where we are, sector leading MVP. Again, this means that MPW, for whatever reason, has found itself on the best performing portfolio 6 out of the last 12 months, right? And that says a lot about the company and its place in our portfolio. Looks like DRE is the sector leading performer. I don't know anything at all about the company. DLR is the company that I'm really interested in and more familiar with. This is server farms, basically. They own real estate for server farms, and I think that's really interesting. And over the years, their performance has been outsized for the sector. And now, as you can see, they've fallen back in line with the rest of these guys. And I think that has everything to do with the consumer, because again, when you talk about a server farm, you're talking about the internet, you're talking about people wanting to, buy cloud space and whatnot. So again, I don't know anything about DRE, but obviously whatever they're doing seems to be working, because it is a definite outlier from the rest of the industry. Technology, again, fairly small sector for us this year. Hewlett Packard, sector leading MVP. We were just in this name and got out. Sector leading performer. We're currently in Corning, which is second leading MVP. Barely negative, but sort of in line with the rest of the market. Intel, you see down here, negative 3% a month, which is not great at all. But yeah, really looking forward to seeing what comes of this Corning position. All right, utilities. I think we talked about this already. Again, really spread out, like more than I think any other sector. And again, that just means that pretty much any of these guys that you pick is going to do just fine in your portfolio. If we want to, pick out a sector leading performer, even that's going to be tough, because so many of these guys are in that 2% range, and there's only one that's negative. So even that's going to be hard to pick out. But EXC, ED, SRE. But again, all these are just utility companies. They may have some small differences that will make a difference in performance, but for the most part, I think they're all pretty much doing the same thing. And like I said, the sector is just really hot right now. All right, let's take a look now at the portfolios and just see what they're doing. So this is the best performing portfolio since July 2021. And we see standard deviation here at the top. This is the current portfolio that we're following. We want to try to mirror our portfolio with this one. I do tend to look at other things other than just, following the numbers as far as constructing a portfolio, but we do try to stay close to this particular portfolio. All right, second in line, dividend up. I try to look at kind of what's in the top 10 to give me an idea of where the market is and where it's going. So we see, I'll say, some defensive stuff in here because we see some beta, right? Beta are companies that perform well when the market is performing poorly, okay? Dividend up, again, a dividend portfolio is more or less going to perform well when the rest of the stock market is performing poorly because they're going to continue to pay a dividend, right? But it's important to note, though, that this is not a pure dividend portfolio because it does have this up score in here. And those up companies are companies that tend to perform well when there's a lot of buying and selling, a lot of volatility, right? So that's really interesting. M-score and alpha, again, we see that alpha, companies that perform well when the rest of the market is performing well. Again, we see the up, down, a lot of volatility, performing well. When the market is not performing well, we got the beta in there. Again, M-score up, beta, M-score down, standard deviation, M-score down, standard deviation. So, and then interestingly, we see the dividend portfolio down here at number 10 on the list. So I think what's happening right now in the market is obviously that, and this is why I think a lot of the MVPs have just been all over the place, is because you really see a real mix here. While you do see some defensiveness, right, with the beta, with the standard deviation, you see some alpha in here as well, right? You see some of these up and down companies that perform well when there's a lot of volatility. So you kind of have to like pick and choose, and I think you have to just kind of ride with whatever you choose, because there's no way you're going to be able to go between a defensive position and a more aggressive position. You just, I mean, if you're day trading, you can do that. But even if you're day trading, trying to decide day to day and week to week what the market sentiment is going to be is very difficult to do. And so I think you have to kind of just pick a side and ride with it. For us, we're going with the standard deviation, which is more of a defensive position. But again, because I know that there's so much alpha out here, I definitely want to take that into account when constructing the portfolio. All right, let's take a look. This is a rolling 12-month calculation. Okay, so this is the last 12 months. As our fiscal year goes on, this will become more and more apparent. Also important to note that these numbers do not include dividend payments, right? Because we just want to see stock performance, right? Just stock performance. And as you can see, all of these are negative, all negative. Last 12 months, all of these portfolios have lost money. The only one that gained anything is this up-down portfolio. And this is just an obvious outlier. This is just a fluke. I don't think there's much to this. Of course, we'll see what happens over the next couple months to see if there's any sort of trend there. But I don't expect that to be the case. And standard deviation, even though it's negative, is still at the top of the list there. All right. Another thing I like to look at is the worst performing portfolios. And I think this tells us just as much about the market as looking at the best performing portfolios. So looking at the worst performing portfolio, and this includes dividends, which is important to note here, right? There's a bunch of beta, a bunch of alpha, a bunch of return. And what this tells me is that, number one, you can't bet against the market. Cannot bet against this market. I think because there's too much volatility inherent in the market to bet against it, right? It's a losing proposition. Clearly, we saw that, having some beta in your portfolio can work for you when looking at the best performing portfolios, but looking at the worst performing portfolios, it looks like they're all full of beta. Same thing goes for the super aggressive portfolios. The straight up moves, again, these are companies who perform well when there's a lot of volatility. It's third worst, including dividends. Okay. The other thing that I saw, return alpha. This is as aggressive can get. That return portfolio is basically companies using a 3-year timeline. So this is from, let me make sure I get this right. This is from, I think, June of 2021 or maybe July 2020. I forget now, but it's 3 years of data. 3 years of data, and it takes the companies with the largest average monthly return. Okay, and this is a very simple thing to just say, hey, these are the companies that have performed the best over the last 3 years on average. Let's put these companies together and let's see how this portfolio performs. And we see that while it is not the worst, it's definitely in the top 10 of the worst for return with the alpha thrown in. Okay, so again, it's kind of a mix. Yeah, and then we see the pure return portfolio down here as well, which is just as bad, but not as bad. All right, rolling 12 months. This is without the dividend, and you see it pretty much stays the same. I think it looks like the return portfolio has risen to being worse than the return alpha when you take away that dividend. But again, all these guys, beta. Again, this is betting against the stock market. So you just can't do it. You cannot bet against this market. Let's take a look at volatility here. So this is the best as far as volatility goes, right? So at the most, I think, is this the minimum or is this an average? This is, okay, this is using a standard deviation as well. All right, well, I'm not going to explain that right now, but the point is, this is the lowest that this portfolio has performed on average over the last 12 months, right? And then we expect standard deviation to be on that list. If it wasn't, that'll be an issue. But looking at the other portfolios on here, return up, M-score up, M-score dividend beta. I mean, it looks like if you, yeah, M-score. So M-score is a management score, and this takes into account the percentage of cash on the books. It takes into account things like current ratio and debt and all these other things. And what this is saying is that if you invest in companies with this great management score, you're not going to lose as much money when it does lose money, right? The fact that you have the up, down, and return up in here, again, I think is sort of a fluke. This up, down portfolio, we're going to take a look at it to see what's in there because there's something weird going on there. But the rest of these guys, M-score, to me makes a lot of sense, right? Now, looking at the worst, yeah, again, we're seeing a lot of alpha, up moves again, return, beta, return. Yeah. So again, it's like you you don't want to be like super aggressive right now in the market, but you don't want to bet against the market either. Is what's happening here. You really kind of want to be in the middle, and I think that's the reason why we're seeing this standard deviation really perform well right now, because it's creating a portfolio of companies that just the price just doesn't move around a lot. Like no matter what's going on, for whatever reason, the stock price for these companies just does not move around a lot at all on average. And that seems to be what's working right now. Okay, so now this is on the high end, right? This is just saying that at the most, this portfolio is going to return something like 11, 12% in any 1 month, okay, in any 1 month over the last 12 months. And this is kind of a prediction. This is not, it's using past data, but again, it's predicting what it can be in any 1 month as the highest return. And so it makes sense that we do see alpha in here. The dividend portfolio is interesting, and I think maybe that has a lot to do with the dividend being paid. Because what I did was I took the dividend and divided it by 12. And so every month the portfolio calculates that dividend payment. Even though dividends are really only paid like every quarter or whatever, the portfolio assumes, just to keep everything even, because all these companies pay a dividend on different dates, keep everything even, it takes the total dividend for the year and divides it by 12. And so every month you're going to see a portion of that dividend payment. And that's why I think just on average, you see that these dividend portfolios have the ability to outperform the rest of the market, right? Right now, especially when the market is currently in a downtrend. And so now we're going to look at, like, maybe it's hard to say the worst performing portfolio, but this is like the highest that this portfolio can perform, right? And it looks like 7% is almost like a minimum, right? Like at a minimum, all these portfolios are to be able to hit that 7% as the highest number month to month, right? So M scores, again, very defensive. Dividend, again, very defensive. And then standard deviation is down here as well. So again, I think that's what's happening right now. Is chasing the money, I think, is a bad idea, but also betting against this market seems to be a bad idea. Let's take a look at the makeup of some of these portfolios. I'm really curious about the about that up-down portfolio specifically. See if I can find it. Well, since I'm here, let's talk about the standard deviation portfolio. So TELUS is the number one position that the program is saying that money ought to be allocated to. Makes a lot of sense. Again, telecommunications, something like utility, not going to move around a whole lot. We know that TELUS is one of the leading performers in that sector. CM, I think we saw that in the financial services sector. Coca-Cola, again, we have option to purchase there. Pfizer, we talked about that, clear COVID winner. Duke is an interesting one in the utility sector, but again, I think that any one of those utilities are going to do just fine. IBM, it looks like it hasn't done much. If you look at the purchase price as of July 2021 and where the price is now, it hasn't done anything. So that tells me that this particular position, this particular company hasn't really done much for this portfolio other than pay out a dividend of whatever that is. And then ENB, again, we have options to purchase shares there. MMM, 3M, I think is a COVID winner. But again, if you look at the purchase price and the current price, it's falling quite a bit. I mean, this is a 25% drop. And so I don't think that having this in our portfolio will do us much good. And I really like what Paychex is giving us right now. And then on the consumer cyclical side, OMC, don't know a lot about the company. GPC, I think, is just a much better fit. And again, it is a sector leading performer, and it has been that for many years. So again, looking at the purchase price and current price, I don't think this company is doing much for this portfolio at all. To have it be at the top of the performing portfolios out of everyone. And then real estate, I forget what O stands. I think it's just O Realty. I think it's O Realty. I think this is just a run of the mill real estate company. I don't know a lot about it, but I have done some reading on it over the years. And I think it's just like a straight up, like maybe apartment and storefront type of deal. But anyway, it's performed fairly well for this particular portfolio. I really do like MPW, sector leading MVP, and I think it's that for a reason. And then the bottom of the list, meaning that this is the company that the program says we should allocate the least money to for this particular portfolio, is Southern Copper. I do want to say that the interesting thing about this company is we come over here and look at the dividend. This is a percentile, right? So when you see this 0.97, that is 0.97 percentile. So this is like the maybe third highest dividend that you can have in our entire basket of stocks, right? And then we see O at 0.91, and then we see Southern Copper at 0.9. So I am really happy to have Southern Copper in our portfolio, even though the price action has not been great lately. It has been in the past, and that nice large dividend, I think, helps out quite a bit. Let's take a quick look at the numbers. Now, these portfolios all are working with $5,500, $5,600 roundabout. I can play around and change this to, 100,000, 300,000. 5,000 is kind of what I started with, and so I figured that I wanted to make the program really work for it, right? So it's like, what can you do for me with only having that 5,000, and where should I allocate this 5,000 to? And that's exactly what's happened. So this is, again, looking back from July 2021, okay? And it's put out $643 in dividends, which comes to about almost 12%. And then the actual increase in the stock price, right? $256, which is a 4% return. And so total return of $900 gives us a total return of 16%, which is the best return out of all the portfolios. The expected return is only 2%. And as you can see, the portfolio cash value is currently $7,000. So you're talking about starting with $5,500 and ending the year, or 13 months with $7,100. It's not a bad deal. So 16% return. Let's take a look at a few of these others. Really interested in that up and down to see what the heck is in there and why it has done what it has done. And remember, this doesn't have anything to do with the dividend. This is strictly price performance. There we go. All right, so I'm really interested in just the purchase price and current price to see if we can find any like outsized gains here. So IMO is energy, so decent outsized gain there. PFG and financial services, that one's pretty big. TSN, Consumer Defensive, is fairly large. Raytheon, really decent return. Pfizer, of course, we know has done really well. And then AEE looks like one of the biggest. So, yeah, I mean, again, I think it's something of a fluke, just because when we look through all of the sectors and the individual companies, even though we've seen some of these names, there's nothing really that just jumped out at me about them, other than maybe Pfizer, which we know for sure has been a really great performer. Raytheon has always been a decent company. We were in Raytheon previously, and then I think this AEE is just it just happens to be that. But also too, I think there may be something to say with the fact that these companies perform well when there's a lot of volatility, and clearly we've seen a lot of volatility based on that chart we saw in the 50-day. So there's something to be said about that as well. Let's take a look at some of these other ones, specifically the beta stuff, because I want to know kind of what to stay away from, right? Now, I may have to go the other direction. Yeah, let's go the other direction. There we go. So this is a pure beta portfolio, and these are the companies that we want to stay away from, right? So Blackstone has performed really well over the years, sector leading performer. Southern Copper is where we are. That's a bit concerning. Coca-Cola is where we're trying to get into. That's a bit concerning. Duke, we keep seeing Duke. EQR, I know them very well. IBM, Tullis, MGA, SWK, BNY, CQP. It's very, very interesting that we're seeing in some of the portfolios some of the same names in this one, but for different reasons, right? So again, I don't think that's necessarily a bad thing, because when we looked at the best performing portfolios, we did see some beta in there. Not a lot, but we did see some beta in there. And of course, again, that's going to be necessary in a market that has this downtrend, right? But with so much volatility, it's bound to be a day that the market is going to be down, and these companies are going to perform well. All right, let's see the return and the alpha. Let's look at these. So Blackstone again, MGA again, OKE, we've seen that one. Corning is interesting. CVS kind of rounding out the bottom there. And so again, these companies historically have returned the best over the last 3 years. And that's what the score is here: 98, 93, 92, 92, 91. So all these guys are really high. It looks like 51 and 57. And this too means something as well, because so historically over the last 3 years, utilities and healthcare, if this is the best return, like 50% of the rest of the market, it means that historically these two sectors do not return, don't have huge performances month over month. And that's typical of utilities, but to see that in the healthcare sector is interesting, I think. All right, Alpha, these are companies that perform well when the rest of the market is performing well. We see Corning in there again. Valero makes a lot of sense. Best Buy is interesting. CAH, Cardinal Health is interesting. So these are companies that perform well when the market is performing well. And I'm happy to see Corning on this list, because again, we do want a little bit of alpha I'm curious now. I'm going to do a quick search to see if I can find Regions Financial in any of these portfolios. And this is going to be tough. Wow. So it's not in any of the portfolios. It has not made its way into any of the portfolios. None of them. Wow. All right. Well, um, nothing to be said there. Another thing I like to do is just do an eye test of portfolio performance. Again, just to kind of give me an idea of where the market is and where it's going. So dark green is the better performing portfolios, dark red, worst performing. And the idea here is to look for something that has a lot of green and not a lot of red. And of course, we're not going to see anything without any red, but I definitely don't want any dark red. So looking at this one, beta standard deviation, not any dark red at all. Well, a little bit. I think it's not going to be able to get away from that. But a lot of green. And as you can see here, this is a negative 9% return for that particular month. But the reason why it's not dark red is because relative to the rest of the portfolios, negative 9% was not that bad. And so that's the reason why we see that there. So yeah, beta standard deviation makes a lot of sense. Again, these are companies that perform well when the market is down and they don't happen to move around a whole lot. And so that's just what I would call a safe bet. Probably not going to make a lot of money, but you're not going to lose anything. Up, down. So again, this portfolio rears his head. This negative 10 is pretty red, but the rest of these really dark green. And I think that really says something. When there's a lot of volatility, those are the companies you want to be a part of. This one has a lot of green. A lot of green. M-score up. Now, M-score is really, again, a defensive position to take. But it does throw in, again, when there's volatility, these companies do well. So, very interesting. Let's take a look at that M-score up portfolio. See what's in there. All right. So first on the list, this is where the program thinks most of the money should be allocated, is CM. CNQ for energy, NWL, Hasbro. First time seeing that one. And consumer cyclicals, Luminen, saw that one before, AEM, Cardinal Health again, Corning, SWK, seen that one again, and then PEG. And again, with these utilities, I think anything you throw in there is just going to work, honestly. And then KM, I've seen KIM on a few of these lists. So, again, I think that being that Regions Financial isn't in any of these portfolios, tells me that while it is a sector leading performer now, right? That it's not necessarily the best place for us to be. And so I will definitely consider getting out of that position as quickly as we can to get into a better position for us. But again, that's something that I'll look at a later date. As of right now, I think we're okay. Sector leading performer, right? M-score, standard deviation, Annalise, always interesting. And again, this is a very defensive portfolio here. IBM, Merck, Southern Copper. Seeing a lot of the same names. Just curious about the performance of this one. All right, the dividend is much higher, 20% return on the dividend, but you're losing almost 12% on the actual stock price. And so, yeah, I mean, literally the entire return of this portfolio is made up of the dividend, and this is not even a dividend portfolio necessarily. I do think though that when you're dealing with a company without a lot of debt, has a lot of cash, typically I think that dividend is going to be much larger than what you're typically going to see. And I think we're seeing that here. So if you look at the dividend score for these guys, 98, 97, 96, 95, 94, 90 and 72, and then 51 for healthcare again. Again, healthcare is just not, so yeah, mostly all dividend. So M-score standard deviation was like what, 1100, almost 1200. Let's see what the actual dividend portfolio is returning. Because these are, the largest dividends in our basket of stock. And as you can see, it's pretty much the same, 98, 97, 96. And still you have Merck, who is obviously has the largest dividend in the health sector, which I'm happy about, down here at 51. So very similar to the M-score standard deviation portfolio. And yeah, I mean, almost mirrors it. $1,100, 20% on the dividend, but then you lose 12% on the actual return. Crazy. And it's not even the same companies, but similar enough that that the numbers are close. Anyway, that's it. Don't want to bet against the market, but don't want to be overly aggressive either.